Hi everybody, this is Gary Dean and this is our nightly video report for Monday, April 11th, 2016. So we pretty much saw a little bit of an exaggerated same move that we saw Friday, where the algorithms try to gap it up, and the minute that the cash opens, we see a high, and or within an hour or two, and then things reverse and head back down again. Today we actually closed in the red, and these types of candles, I'm going to kind of expand this for a second. These candles, they're showing us that there's selling going on, and you can see they're long, and it's the same as at the bottom. When you see these long tails at the bottom, it means that there's buying going on, and they're typically reversal candles. So I would say the main thing that the bears need to do right now is get it through to 2033, and then from there, we should see a quick drop down to the 2021 and even the 2014. This is where if I'm going to follow a fractal pattern, I'm going to go back to this move right here. From that, we had a drop and came close to the 200-day moving average that was or the 50-day moving average that was moving up on it, and then from there we made a test of these highs, and then from there we obviously know what took place. So if we're going to follow that and just use it as a as let's say a guide, because it is very similar, you can see this moving up just like this was moving up, and that would give us a target someplace right around this the 1977 area. Now, the fact that this move was a lot more extended than say this move, where if I just draw the, let's say our time and price here, and now take this and move it over, this is what I'm talking about, where you can see we've overshot this time period as well as price by it should have made a top on 321, and we're on 411. So there's no guarantee that it's going to follow it exactly, and we may not even find support. The main thing that I just continue to say is just the duration of this bearish divergence. This is not something you want to buy into here, especially on a daily chart. It's very, very dangerous. And the fact that we have the 200-day moving average is moving down, or the 200 days here. I'm all confused on which one is which, but in any case, they're moving down, and that means that this is still a bear market until they start moving up and we start taking out highs. And right now we haven't done that. Now, can it change? Absolutely, but I just think these gap ups that they continue to try to do and get sold off, we're going to at least have to come down and do a test before they're even going to try higher again. And if they don't, it's just going to extend these bearish divergences even more, and then it's just really going to set up more of a this type of move instead of any kind of chance to get the bulls out that have been buying up here. So I don't have to go through all of the just internals, because nothing has changed. They're still very, very overextended. On the 60-minute chart, this head and shoulders pattern obviously is a little sloppy right now, but it's still kind of in play because we never took out this shoulder. This has given us a target someplace down at the 2009 area. Again, bearish divergences when we started making these highs here, and it's something you just really want to keep an eye on, because the moves that have taken place, a big chunk of it has come when the markets are closed, and they're doing it in after hours, and it just leaves what I call these air pockets underneath, which are the gaps that are going to get filled. And it's not an environment that you want to become complacent in, because it's very, very dangerous, because once they give up, then everybody turns into sellers and we start heading straight down. And the fact that there's not a lot of, say, volume support because of these gap ups, these support levels that people bank on get wiped out in a heartbeat. So right now, I think the important spot is this 2020. Let's say the first one is going to be 2033, 2023, and then the bull bear in the line is coming down at this this 2010 area, and if it breaks that, then I think we get a very fast move down to this level here. So what the bears need to do, honestly, they just need to keep it below these, these highs here. And you can see this trend line right here keeps knocking down the S&P right there. And now we have the moving average that's starting to move down. And it's, as long as the bears can kind of hold these levels here, then what the bulls have to do is defend the 2033. If they lose that, then I think we're starting to see a changing of the guard. And what happens is we're making a rounded top right here. On the 15-minute chart, they tried to break through this 78% retracement. You can see that was really just gap up right here. And then again, we just saw selling. This is not a bearish, a bullish pattern right here. And if we're just going to, obviously where I had this as an A, B, and I said this, we could have the C coming down. Really the way that I would, relabel it is we just made another ABC move. And these are just larger ABs, and really the main thing to get through is that I do believe the larger move is going to be to the downside, even if they do try higher. We haven't really seen price react to the downside, even with today being down. It's we need to start seeing daily closes, that we start breaking some of these things, that we know that the price is finally reacting. But they've been trying to hold this up really with gap ups in the morning, and it's just a dangerous environment because there's not a lot of volume when they do that. And these gaps that are underneath are air pockets, and it's like building a foundation on sand. It's not secure, and they've been doing this for a long time. And obviously the markets have been continuing higher, but it doesn't make it safe. So with that, let's see if today was finally the day that we get some follow through to the downside. And until tomorrow, have a great night, and I'll talk to you guys in the morning.